My name is Robert Bonavito, New Jersey forensic accountant. This video is part of a series of videos where I discuss forensic accounting topics for educational purposes only. If this was a litigated matter, I would take a different approach, have different conclusions based on different facts and circumstances. My name is Robert Bonavito, New Jersey forensic accountant. Today I'm going to talk about a relative valuation method, and it's a way we use to value companies. In the relative valuation method, we try to find similar type companies to compare the company we're valuing to. And, remember, valuation is really a craft. Okay, the more you do it, the better you get at it. Just like cooking, the more you cook, the better you get. The plumber, the more plumbing you do, the better you get at it. And so, the more we do, the better we get. And we've been doing this for 30 years. But with a relative valuation, it sometimes it's rules of thumb. Some companies sell at rules of thumb. A multiple of sales, a multiple of discretionary seller's income. Especially small businesses. If the seller is making $30,000 a year, or maybe it's 3 times discretionary income, they're selling for $90,000. And for small businesses, we find the rules of thumb are pretty accurate. Because the person going in is not thinking they're going to make $30,000 forever. They're thinking they're going to make a lot more. But that's what the company's making now, or some multiple of sales. And this is, for small businesses. For larger businesses, what we'll do is we'll actually go out into the public market. We have databases. We'll pull down information. Let's say we're doing a company in the auto field. Or we'll go look at Ford, we'll look at Chevy, we'll look at all the companies. We'll do analysis of the balance sheets, of the P&L, try to derive, PE ratios, cost of sales, EBITDA, all kinds of good stuff, returns on equity, and then we'll compare it to our oil company and try to find a comparison. And if we're able to do that successfully, well then I have a publicly traded company with a stock price, and I know what let's say I'm using a PE ratio, and I know that you're selling 6 times earnings or something like that. And if your company's making $100 million, well, it's worth $600 million. So this relative valuation method is very useful. You can apply it to lots of different companies. It gives you, sometimes we use it just as a sanity check. Maybe we'll do intrinsic valuation, and then part of that we'll do the relative value. The intrinsic is really the cash flow. We'll compare it to see if we're in the ballpark. It should be pretty close. If you have any questions on this video, feel free to contact me.